Hey everyone, and welcome to this explainer. Look, if you're a tax professional or an advisor working with corporate structures in the UAE, you already know that things can get complicated incredibly quickly. Today, we're going to act as your senior advisor, walking you through a really critical strategic breakdown based directly on the latest UAE corporate tax framework. We're going to look closely at multi-entity filing strategies, which, honestly, is arguably one of the absolute most vital decisions you're going to make on behalf of your corporate clients.
So picture this scenario. You've got a client sitting right across the table from you, and they don't just own one simple business. Nope, they're running a dozen connected companies. We're talking subsidiaries, separate holding companies, the whole shebang. And they are looking directly at you for answers. How do you handle their taxes? If your immediate thought is a sudden throbbing headache at the prospect of filing 12 completely separate corporate tax returns, managing a dozen different compliance timelines, and dealing with just an absolute administrative nightmare, well, if you're reaching for the aspirin right now, you are definitely not alone. But the good news here is that there are structured, strategic paths designed to solve exactly this problem.
Okay, let's dive into this. We're going to map out the strategic decision tree today, covering the baseline multi-entity challenge, how to form a UAE tax group, the bilateral relief alternative, and finally, how to practically scope your client engagement.
Right, so starting off with the multi-entity challenge.
The baseline reality for almost anyone advising businesses in this region is that your clients usually won't operate as a single isolated entity. They're running a group of UAE companies under common ownership. And if you approach this without a unified strategy, it literally means you are facing a mountain of separate returns. Every single entity would need its own standalone filing, its own isolated financial assessment, and separate tax payments. It's a lot. But thankfully, the UAE corporate tax law throws us a lifeline here with some really powerful alternatives to filing individual returns for every single connected entity.
Which brings us to our first major strategic path, forming a UAE tax group. Now, a tax group is an incredibly powerful framework. It allows related resident entities to file a single consolidated return. And the real magic phrase here, it treats the whole group as a single taxable person. From a compliance standpoint, this is a total game changer. It completely eliminates the need to track and report intra-group transactions for corporate tax purposes. You just consolidate the financials of all the members, and you deal with the tax authority as one unified block. But, as you might expect, they don't just let anyone form a tax group. The barrier to entry is pretty steep. Now, what's really interesting about this slide is the sheer scale of the requirement. Look at that massive 95% slice right there. To even be eligible to form a tax group, the parent company has to hold a staggering 95% threshold in the subsidiary. And we're not just talking about a casual ownership metric here. That is 95% of the share capital, 95% of the voting rights, and 95% of the profit entitlement. You can hold this directly or indirectly, but that 95% bar, it's absolute. The law essentially demands near total integration of ownership to grant you that privilege of being a single taxable person. And beyond that 95% ownership rule, there's a strict checklist of non-negotiable conditions you have to meet. Let's run through them real quick. First, like we said, the parent must hold that 95% stake. Second, every single member of the proposed group must be a UAE resident juridical person. Third, they all have to use the exact same accounting standards. And fourth, this one trips people up. They must all share the same financial year end. If one subsidiary closes its books in December and another does it in March, they cannot be in the same tax group. You've got to align those dates first. It's a precise, all-or-nothing kind of deal. Oh, and a quick sidebar for those of you dealing with free zones. We need to highlight a very specific caveat here. Free zone persons can generally only join a tax group with other free zone persons if they enjoy the exact same qualifying free zone person or QFCP status. You can't just willy-nilly mix and match standard mainland companies with qualifying free zone entities and expect to consolidate them. The statuses absolutely must align. So, why go through all this effort? Let's weigh the pros against the trade-offs. The primary benefit is massive administrative simplicity. You're dealing with one return instead of a dozen. And perhaps even more powerfully, you get incredibly easy loss offset. You can take the losses from a struggling group member and just offset them against the profits of another within the exact same tax period. No need to file any separate loss transfer elections. But the trade-off is serious lock-in. Once this group is formed, pulling a member out or restructuring the group triggers a really complex set of tax consequences. It's honestly very much like a corporate marriage. It's easy to enter if you meet the criteria, but potentially incredibly messy to dissolve. So the crucial point is captured perfectly right here. This decision shouldn't be made purely for short-term convenience. Forming a tax group is a profound, long-term strategic commitment that permanently alters the structural compliance of your clients' businesses. You definitely don't want to group entities just to save a few hours of paperwork this quarter, because untangling them next year could be an absolute nightmare.
All right, moving on to the bilateral relief alternative.
So, what happens if your client hears about that massive lock-in and suddenly gets cold feet? Well, here's the plot twist. Think of bilateral tax loss relief as your trusty sidekick option. This framework allows you to transfer tax losses between two UAE resident group companies without requiring full financial consolidation. You aren't merging them into a single taxable person. They stay completely distinct entities filing separate returns, but the law lets you purposefully shift a loss from a struggling company over to a profitable one in the same group to bring down the overall tax burden. It gives you a massive chunk of the benefit without that heavy administrative lock-in.
And this brilliantly illustrates why bilateral relief is so incredibly attractive for a lot of structures. Just look at this compared to our last chart. For bilateral tax loss transfer, the common ownership requirement drops down to 75%. You only need 75% common ownership between the two entities transferring the losses, compared to that massive 95% barrier we saw for the full tax group. This makes it so much more accessible for things like joint ventures or subsidiary structures where maybe the parent company has taken on some outside investors, but still holds a strong 3/4 majority. To quickly summarize the choice here, bilateral relief gives you the ability to strategically move losses around with way less administrative complexity and lock-in. The entities remain separate. On the flip side, a full tax group offers you the ultimate simplicity of one single return through full group consolidation, but you're paying for that with strict rigidity and super high ownership thresholds. Honestly, bilateral relief is very often the most practical choice for groups that really want those loss benefits, but just don't desire or maybe don't even qualify for full consolidation. Okay, so let's pivot from tax theory to the real-world scoping of your client engagement. Let's move to and see how this builds into the practical conversation you have to have with your client. During the scoping phase of any engagement with a multi-entity client, you basically have to guide them through this exact three-step decision tree. Number one, do we want to file as a full tax group, assuming we even meet that 95% threshold? Number two, if not, do we want to remain separate but actively use bilateral loss transfers across our 75% owned entities? Or number three, do we just play it simple, file each entity completely separately, and silo their profits and losses? You really can't begin your work until this specific path is chosen. And why is getting this right in the initial conversation so vital? Well, because the client's choice right at the beginning dictates literally everything you do downstream. It dictates exactly how many individual tax registrations you need to apply for. It dictates the total number of returns you're legally on the hook to file at year-end. It permanently sets the rules for how losses are allowed to move through their corporate structure. And ultimately, it completely defines your actual filing mechanics when you sit down, open your laptop, and log into the AmaraTax platform. So, as we wrap up this explainer, I want to leave you with this thought. The corporate structures you're dealing with, yes, they are complex, but the strategic frameworks provided by the law are actually quite clear. You've got the full tax group, you've got the flexible bilateral relief, and you've got standalone filing. The real question is, when you log into AmaraTax for your very next multi-entity client, which of these three paths will you confidently lead them down? The knowledge is in your hands now. Thank you so much for joining me to explore this, and I'll catch you in the next one.